G'day everyone, my name's Oz, Accounting Director here at Elephant Advisory. Today we're going to discuss tax planning tips, and we've got 5 to review. Quite simple ones, and we'll start off with tip number 1, which is ensuring you're in the correct structure. So what we mean by that is you may have started a small business as a sole trader, and obviously as your business grows, maybe the structure that you're in is not as efficient as needed. Therefore, it's important to reassess that and to discuss with your accountant whether a trust or a company may be of valid use there to obviously minimize tax and get access to different sort of tax rates. So we have got a video on our website discussing different structures. So I guess go and revisit that video to learn a little bit about structures and the tax rates within different structures. Tip number 2 would be to forecast out and budget your year-end financial statements. So essentially, the best time to do this is after the March BAS has been completed or 9 months of trading has been completed. This will give us a good idea of where the business is tracking. Therefore, we can, extract out what we estimate the June balances to look like, and based on what we estimate, we can then plan our business to deduct certain expenses before June, maybe delay some income, etc. So it's a really good piece to look at the numbers and review the numbers with your accountant to ensure you know where you're sort of tracking. Tip number 3 is timing of income and expenses. Obviously, reflecting back on tip number 2, once we've done our forecasts and budgets, then we can reassess, okay, what are we doing with our expenses and income for the financial year? So things to think about, obviously, if you want to bring forward some expenses, if you've got certain repairs that need to be done within the business, if we have, superannuation contributions that we are doing for our employees, if you complete them before June 23, you're essentially moving the deduction forward into the current financial year. If we've got any prepaid expenses such as insurance or any other commitments, you can expense them before the end of the financial year, which will reduce our profit and loss, therefore minimize our tax. Another one to think about in this period of time is bonuses on staff. If we're committed to paying bonuses on staff, if you bring them in before June 23, that means your profit and loss does reduce, which will minimize tax again. Tip number 4 is reviewing all assets. So you might have assets that are quite old if you've been operating a business for some time. If we have old assets, we can write off those assets. If we have new assets, basically acquiring new assets before June 23 will benefit from the small business accelerated depreciation write-off. So that technically means any expenses such as, if we were a building company and we had to buy, let's say, a crane, and the crane is 200,000, we can basically write off the full expense in the financial year, in June 23 financial year. Obviously, moving forward in different financial years, it's wise to review what those limits are, because these limits do change from financial year to financial year. Tip number 5 is just to review your debtors. You might have very old debtors that are within your accounting system that haven't paid your what's owed to you. So basically, we want to review those. Any debts that are outstanding above potentially 12 months, you probably want to review, get in contact with those clients of yours, and whether or not they're going to pay, we can potentially write those off as bad debts, which will mean we have additional expenses, therefore reducing the profit, therefore reducing the tax. It's obviously nice to reassess this with your accountant each year, as these tips do change depending on certain rules that the ATO have. So just to give you a quick rough summary again, so we've got review the current structure, forecast out your profit and loss for the financial year, assess the timing of income and expenses. If we have some certain income that we can push into the next financial year, or CGT events that we can push into the next financial year, it's wise to potentially push it, and you can get another 12 months to pay your taxes. Obviously review all your depreciating assets and whether or not you can write them off, and if you need to acquire new ones, and obviously review all your debtors. Thanks a lot, guys. Cheers.